Important information and disclosure. TDW Trader Live seminar presentation is for educational purposes only. All trading ideas discussed by the instructor are for demonstration purposes only. Trading involves a substantial risk of loss and is not suitable for every investor. Past performance is not necessarily indicative of future results. Please read more at https://ttwtrader.com/disclaimer. Hi and welcome to day 3 of our seminar Bookmap Masterclass Trading with Limit Order Book and Bookmap. Before we continue with the sweeps, I would like to add something to liquidity. Be aware that liquidity answers the questions where the price is likely to go, and it shows levels of interest. As we discussed yesterday on day 2 in our seminar, liquidity acts as a magnet. It's a source of energy. But liquidity does not answer the question where to put my money blindly on and in return expecting a high probability trade or return. We must find methods or a methodology to get as close as possible to this answer. In order to do that, we know the nouns now: liquidity, absorption, exhaustion, and sweeps. Additionally, we need verbs to understand the language incomplete. Once we understand what the market is telling us, we can build methods and strategies which have a high probability rate to win and keep us profitable. That means a low risk and high reward ratio. Before we continue with strategies, I need to mention that what we have learned and discussed about the limit order book and its visualization with Bookmap, it's not the holy grail. It won't work 100% every time. But it will work far better than any other trading systems out there. I claim that it works at least 70% of the time, and that's a lot. That's a huge probability chance to win. The best of this knowledge is if you find your own way based on this educational material and knowledge. It will give you or restore the confidence in yourself. That's what matters. To quote Kahneman, you will use the system which is more logical, deliberative and slower. In this case, you are in full control of yourself. If you reach this point, you don't need anything else for trading, because the principles we went through this week are valid for every traded and liquid instrument worldwide. Good. Sweeping. Sweeping is trading through one or more levels very fast. That means trading through one or more price levels very fast. Big aggressive market orders come in for some reasons. I'm still thinking about the reasons of these market orders. It's really hard to answer why they are coming in, but they are there. These aggressive market orders mostly are leaving unfinished auctions. By that I mean there could be and are several price levels which are not traded. There are several price levels which are not being traded. There are several price levels which have not been traded. It leaves so-called low volume nodes, or you can also call it gaps. It's up to you how you see that. They are fast and powerful refusal of prices. Speed of price action is important, as we will see, and we will also talk about stop runs today, or stop runs. We have a nice example in yesterday's trading, in yesterday's auction, about a stop run. We will go through the stop run then later on. So sweeping are extremely fast and aggressive moves. We should keep this in mind. Excuse me. I'm too fast. So sweeping or big moves. Fast and powerful moves are initiated or ignited by algos at exogenous events like certain political or economical issues. You know what I'm talking about, because today and in last months, years, we see that every tweet, a political tweet, especially when it comes to the tariffs between US and China, for example, shakes the market absolutely brutal. There is no hope. If either you are on the right side, or maybe you will be stopped out. The negative impact of the sweeps is if you are maybe in between in the trade, you get a huge slippage, because it's more likely than that your position won't be traded. That means you will be stopped out a few points below or higher. It depends on where you are, where you are in the market, and that means sweeping are really fast and powerful, and I would even say brutal moves, which are initiated by exogenous events. Prices then sweeps through a range of prices, leaving an order vacuum in its wake as time goes on. We will see that. You will see that because in bookmap it becomes obvious. It becomes much clearer than when you trade from a candlesticks chart what's really going on and what's happening. It's the first time when I started to examine this behavior and to see that it's there's one, I think, not one but several golden bullets or arguments pro bookmap, but recording function and replay function is the most important part. At least it is for myself. I hope it's for yourself too. This recording and replay part of bookmap, because it puts you in the situation, although yes, it puts you in the situation that you can replay every day. And if you want to see what is really happening at a certain level, maybe because you doesn't see what is happening, what happened there, or you want to exactly see what happens, what triggers the event, what triggers the market to go long instead to go short, like we did it on Monday and yesterday, watching the limit order book and see that there was absorption, that they're trying to sell into the bids, and every sell was absorbed by the buyers. So new orders come into the void. Large market orders arrive so fast that the queue does not have time to equilibrate between their arrivals. Let me show you again this example here on Excel. When we are talking about a queue, then we are talking about queues on the limit side here, on the ask side, on the bid side. So you can imagine if we split the 16 orders here, then you will see a queue of orders, as we talked about the prioritization of the orders. So when you look very, very closely, and if you zoom in, if you look at the 16 orders under the microscope, then you will see a one is sitting in the front. This is the priority 1, and 3 are sitting here. Then we have 4 sitting here. Then we have 2 again on the 4th place here, and so on. So we have 4, 10, and maybe 3 here and 3 here. That's the queue. So if you want to trade and you put your trade on the limit side, you will be assigned a queue position, and you have to wait until you will get filled. This is the first in, first out principle of the CME. We talked about FIFO on Monday. You can see it in video again, or go to the CME page where they are explaining very well what the prioritization system of the matching engine is. When we are talking about a queue, that means large market orders arrive so fast that the queue does not have time to equilibrate between their arrivals. You will see that very, very often when a sweep happens, that they are simply, going very, very fast through different price levels, and there is still an imbalance and leaves an imbalance behind. Market making programs see the orders and they seek to execute them, so price retraces. Sweeps or big moves are absolutely important. Let me show you what I mean, and we will come immediately to yesterday's example. This is an example where what was it? It is from January 2019. It was a tweet of rumor that tariffs between US and China are on a good way to be solved. Ending the tariffs war between the US and China was and is always a positive sign for the market. Of course, this message was a positive sign. And what I wanted to show you, it's only one example, but you should be alerted. So this was before, I think it was a tweet before the message. And this is, that happens 1 second or 2 seconds after the sweep. You see that? A large order is hitting 24. We are trading, before we are trading at 21. We have traded 0 contracts and 0 contracts here. So again, going back a little bit, by the way, you can examine it, this behavior on your own. When you record and replay, you can do that. I will show you in a moment what I mean by that. And that means we have 151, 39, 39, 18, 18, 54, and so on here in the queue. And then this message was launched, and you see that these people are not hit. This was not traded. The first trade happened at 24.50 here, at this level. Some sweeps are so brutal, so fast, that they leave gaps below or low value or not traded areas here. And maybe you are a fan of gap trading. The theory is that every gap should be closed or must be closed. We see that in daily trading, for example, when we are together in the education room. I'm watching these gaps really closely, so to get a clue if we get liquidity around the gap, so the gap is there, then it's really likely that the market is trading against the gap, a trend against the gap, and then reverses back. That's one strategy, one possible strategy. But you see that some sweeps are so brutal that they leave simply price levels unmatched, untraded. I showed this page yesterday. Look here, this is a DX viewer from DX feed or DX feed viewer. Yes, DX feed market data viewer. The good thing is it splits the data feed into their parts. So there's a timestamp. There's every your trade. If you are trading, you get a start timestamp. You got an ID. Then several other options were given or attached to your trade. How much you trade, are you buying or selling, and so on. So that's quite interesting to look a little bit more inside the data feed and the data structure of our entries, what we are doing daily. But most interesting for myself was that there was a sweep. I catch this sweep here and made a screenshot. You see the price went up without polling anyone here and here. The matching engine started polling at this level here. Doesn't matter what price it is, but just to show you, based on this foil here on this page, that sweeps are running through the price levels without caring about to Ask, do you want to make business with me, or do you want to make business with me? So they are not polling. They start polling a little bit later when the sweeps come to an end, or in between, of course, or in between. So we should keep in mind that this behavior happens nearly, first of all, every day. It happens nearly in every instrument. We will see some strategies how to deal with sweeps. What should we do when they happen? I would like to show you that sweeps are very fast moves, and they leaves a lot of prices untraded. There is no trading here on these prices. They lift the price extremely fast up. This is the same trade from January based on the how to say on the trade tariff announcements of Trump, and you see how the market reacted. This is one really brutal one. There's no chance. If you want to trade this one, you got no fill. And as always, we discussed yesterday, you see that this is a black hole around, black space around. The informed traders are not willing to trade this one. See that? Liquidity comes back later, as every time when similar events happen. So it is really hard to trade this. It is not, even I would like to say, it is not tradable. We have to wait until liquidity comes back. Let's go to the scheme of the sweep. We have here our offer side, okay, 32, 24, 16 and 12 contracts. We have below 15, 18, 22 and 34. So we are trading at the best offer here. And suddenly 15 contracts, aggressive 15 lot sell order hits the bid. And what happens is very obvious, that they are selling everything below. So they are sweeping through and leaving a vacuum here on the way down. You see this? That's the scheme of the sweep, but I think it's understandable what it happens when a big move comes up. The advanced concept, we will talk about that. Now, the point is, what I would like to discuss with you every time we are going through this sweep and to the strategies. You know, we have a Pavlovian reflex is a kind of conditional behavior. So sometimes we are used to jump on the train or on the move because something happens. It goes very fast, up and down. And then we act with a reflex and try to jump on the trade. That's a Pavlovian reflex. That means we are used to trade breakouts, for example. Whenever fast move goes through the level, we jump on this move without thinking. It's simply a reflex, or maybe also part of our strategy. I don't know. You have to answer it by yourself. And we hope then that this move goes further on, that there are enough people behind us who are supporting us or supporting to move so that we are in profit. If we are trading with this reflex, for example, we are conditioned to do something, to see a candle is jumping up and then we simply join this move. It happened to me very often in the past, and especially in the first trading years, because I didn't know what is happening. So I thought when the move is so fast and it's going in one direction, there are a lot of pressure in the market. I have to join the move. At least I hoped that this move goes 10 points away from my entry position to be, yes, to get the profit to cash in the profit very fast. But this is not true. This is simply not true. You will see that in a moment. Sweeps can be successfully be traded. That means if we are trading and talking about the sweeps, as we must trade sweeps against its direction. At the end of the move, really you will see it works more than 70%. I did a measurement based on a 1 month ES. I've got a little bit higher number for myself when I just only, I didn't trade, I just examined the moves statistically. They were good for at least, in my examination it was 80%, so something around 80%. I would like to say, not to exaggerate this one, but say they are working for at least 70% of every trade. And that's a huge number, guys. That's a huge number, ladies and gentlemen. This is a huge number. 70% to be on the right side, it's an extremely good number. I would like to go through the yesterday's example, and I would like to go through the yesterday's sweeps. Happened at 5:30 my time here, around here. This is the one I would like to talk about. Good. So please be concentrated. It's an exciting example of yesterday's event. As said, it happens around 5. Look here, this is the timestamp, 5:36, 37. What I'm doing here is I would like to jump into the 5:36 time now. What I have done is I have double-clicked in the market order column. I have double-clicked in the volume profile here. And as well, I have double-clicked and cleared the quote center column here. Okay? Okay, then let's go and let's jump into 5:36, I think it is. Just make it a little bit faster. You can jump into the timestamp and then select the second you want. And I have the normal, switch back to the normal speed. Let's start again here. So, let the games begin. You see an innocent market at the moment. Nothing unusual. Liquidity is coming up at 24. I mean, nothing is indicating that something is going to happen. What is happening here? What's this one?
The liquidity on the bids.
Yeah. We are talking about sweeps. I ask, what is this black area here?
The black hole is no liquid in.
Yeah, absolutely. Yes.
Exactly.
They pulled liquidity. Let's see what happens. What happens after this? And by the way, this is also a part of the language of markets language, because it seems that other people knew more than we. Keep an eye on that one. Let's continue a little bit. We can go through this slower then, but let's see what is happening here. You see these green bars here coming up? A huge number was traded at 21 and a quarter here. A huge number was traded there. 1,310 contracts. This is this big dot here. Don't know whether it stops here, but you see following. First of all, we will come back to them when we are talking about strategies. The room, the space around this sweep is darker than the space on the left side. This room is, or this space here is darker than this one. And every time when this happens, a lot of people who are professionals, every professional cancels his limit size. That means we have less liquidity, in this case on the bid side. Even on the ask side, we look here, we are talking about 100, 200, 100 and 200 on each side. You see that? So this is an indication that the market it is not in balance. Then have a look here, please. Have a look at the volume profile. I have reset that both the quote center here and the volume profile. You see extremely well what and where is something traded on what price. You see that there was a trading at 2050, 2075 here, very small trading, if even they traded then. The next one was 21.25, 21 a quarter here. Then the next one was at 22.5, and then it comes to an end here. See that? So that means this sweep is so fast and so brutal that it leaves imbalance on the way up or on the way down. It doesn't matter. The principle is every time the same. But it gives us a clue that this sweep, whoever ignited the sweep, I'm in my imagination. There's maybe one guy who is sitting there and reading the paper, and suddenly a news is coming in, and then he press a red button, for example, and this is the sweep. For whatever reasons, maybe those people who are ignited or who are initiated the sweep wants to go out of the market because they get more information, and they have that's the best explanation. Their inventories are full of contracts. They want to close their contracts. You see that? They're trading them at contracts, and they get rid of everything they have. That's the best probable explanation I have for the sweeps. What happens? You please remember that when absorption happens, that this is not the normal absorption we talked about yesterday, but anyway, it's absorption because they traded with the sellers here. So they sold 1,310 contracts into 21.25. They traded this one, and that one here. And we talked about yesterday, if this massive amount of volume is traded on the way up, what happens at a certain point in the market? What do you think? What is happening when absorption happens in the market?
I agree with Angelic that the energy is absorbed.
Absolutely.
So it's I kind of go into the volume profile mode of the nodes there, and if the low volume node doesn't hold, we're probably going to retrace.
Absolutely. That's the point. The best, as I said, my best explanation is that I call it also, this is an capitulation. What we are seeing here in every market, let's take this market, here this ES market or whatever market, share market for example, we see only part of contracts or shares in the market. If you are trading Apple, for example, I have Apple here, look here. So if we are trading Apple here, and you see this huge number sitting here, 15,000 shares traded at 66.83 here. We have 11,000 shares sitting at 66.90. We see only a fraction of all available shares of Apple, of Microsoft, of Amazon, whatever company you want to name here, but it doesn't matter. This is only a fraction of all available share of this company. It's logical, absolutely logical. We don't see all shares of Apple into one in one exchange where this product is traded. And the same is valid. The same is valid for every future contract. We see only a part, maybe sometimes only a fraction of all available future contracts for ES, for the treasuries, for oil, for example. You should keep this in mind because this is really, really important. Therefore, we are talking about iceberg orders. Let me add, maybe, I don't know whether I have, no, I don't have added the iceberg detector here because it's, from my point of view, not usable for my trading at least. You see that we have icebergs all over the chart, the trading time. So please keep in mind that what we are trading here is only a part what is really available. It's not every contract available in the market. A lot of people who are, yes, in charge of moving the price, they are trading 100, 200, 300, 500 lots. And in order to get these 500 lots filled, they need time. First of all, they need time. And second, they need buyers or sellers, depends on, for example, to sell them their contracts. This a mess. You can't sell 500 contracts in this market. You know what happened? This will bring down all prices, or vice versa, bring up all prices. That's very logical to understand, isn't it? First of all, if we are thinking about that this is only a part of the available contracts here. It doesn't matter whether we are talking about future contracts or we are talking about stocks. It doesn't matter, because we only say a portion, a part of what is available. Then it can be that this, let me say this is one person, one guy who is sitting in a room reading his newspapers, and suddenly he got a message that something is going to happen, and he pushed the button, and then the order is immediately executed into the market. He get a fill, he traded at 21, then he traded maybe on the way up, and he cleared his inventories. Maybe he is done now for this trade, and he waits for another trade then. This is one of my explanations how I try to answer the question why it is not important, but at least for myself it's important to get a picture of what is happening on the way up. Yes, it's the same one. You see that? What we not see is the limit order book, so we can't say at the moment what is happening. But we will use this behavior to build strategies upon this behavior. Either you are long, you are a lucky guy, you are long, and you get your, I don't know how much this was, this 20, 30 pips, or not pips, but ticks. Anyway, it doesn't matter. Then you are long and you get your target within a second. Close your PC, enjoy your life, enjoy your time, and do anything else. Or if you see that you're not in, wait. Simply wait. You will get enough chances to trade, or to get this, to get the opportunity to trade this.
The only problem with sweep in a crude oil versus sweep that you just show us is the speed.
Yes, it is, but
the ES was kind of like the gentle. You can still react. This one, no. It happens in like literally 2 seconds.
Yes. Absolutely. So also, if we are looking, this one this was, as you said, a gentle one. So it happened, but it was already, look here, maybe 1-2 seconds, and a sweep. Let me say that and stress it again because it's absolutely important. A sweep is described by a 90-degree move. 90-degree move. Maybe it is 88, 87, 89, whatever. But let's say a sweep is always, let me show you that here. Yes. It's a 90-degree move. You see that? So this is one characteristic of sweeps, and we do not jump on board here. We do not, but by the way, it's questionable whether you will get a fill here. But anyway, we do not jump on board. We do not follow a hidden reflex or whatever. We don't do that. We wait patiently until this ends, and then we have a look what we can do then. Okay, sweep is always a 90 move degree. Please keep this in mind. Let's see what happens next. If you want to join this ride, maybe you get the fill if you are lucky at 22, 21, 22 here, but it's really, really hard. It's really hard. It's really hard to trade this one, and I don't recommend, because it's so fast, it goes so fast up, it can go as fast as it went up against you, especially in oil. Keep your hands off and wait until we discuss the possibilities around the sweeps. Let's do it a little bit faster now here. You see liquidity is forming here. Let's do a little bit of practice here. What does it mean when we have liquidity here at 24 and 18?
We're bracketing.
For example, bracketing, what is the price likely to do?
Go to 18.
Yes. So this is our, yeah, excuse me.
Well, how much is in the book at 18 and then down at
645.
No, before that, that very dark red before the sweep up. Can you, is it like 1,000?
Where do you mean?
At price level 18 to keep going north to the left. Yeah, that area there.
Let me see that. Just a moment. Let me see that. No, it's 783.
Okay. Because it's interesting to watch this guy come up from the bottom. He started down at 12 or 10. And if you look, so see him down there at 12, and I think he was even down at 10 earlier. Yes, he was. He was down at 10, then he moved up to 12, and then he moved up to 16, and then he moved up to 17, and then he moved up to 18.
Yes. Yeah, absolutely interesting. This is called either he is chasing something, or he is spoofing something, spoofing the market. You know, that means he is lifting his intention to buy. He is showing his hand. So what he intends to do. So the only point is you have to know. You have the software, the data, to see what the poker player is doing. If you are going, let me show you that here. If you are having something like this one, candle, yes, and simple candle charts, I'm using these charts for my cloud notes to see where was the low, where was the high, what was the open, and so on. Then you can't see anything. On the other hand, we have today's software which are plotting all the liquidity in, but this is also highly questionable, because in order to get an accurate, more reliable result, you have to have the data feed which is providing the best possible data to analyze, to get this analysis done here, or to get this analyzed and to understand what is happening here. Based on that, what we have learned yesterday, on Monday, and especially on Tuesday, that means yesterday on the second day, price is now most likely to go either toward 18th if he keeps the liquidity here, or bouncing back for 24 to reach the 18 level here. Let me just jump a little bit forward. We will use this example of yesterday's again to go through the liquidity and absorption stuff we learned yesterday. Let me see what is happening. Okay, here's canceling here. Here's canceling. You see that? This is spoofing here. Real life. You don't need any indicator. You don't need anything to understand what is going on here. This is stair 1, this is stair 2, this is stair 3 in this case. Maybe below 12 was the...
And he moved up to 21, Walter.
Sorry?
He moved up to 21. See that?
To 21? Where?
Yeah. So see where he pulled at 18? If you go straight up.
Oh yeah. Yeah, that. Yeah, I see that. Yeah. Yeah, we have several difficulties here, to be very open, and therefore we should discuss it and understand. We have a workaround to trade this moves here. Of course, we will discuss it a little bit later, but we have several difficulties. First of all, it is so fast. It is, look here. Let me stretch this a little bit. It started. Let me say it started at 38 minutes and 40 seconds, and it ended at 39:04. So we are talking about 24, roughly 25 seconds here. We are talking about 20 seconds here, and that's a very gentle move. A smooth move, so you have 20 seconds to join the move and to exit. But the second difficulty with these sweeps is it's really hard to say where these moves end. Where's the end of the move? Is it here? Is it here? Is it here? Really hard to judge, really hard to say, okay, that's the end of the move. We have two uncertainties here. First of all, the speed of the move, and the second is that we don't know where the move ends. These are facts. We can't ignore them. These are facts. We can't ignore them. Either you are brave and you have enough money in your account, you can say, okay, this is a sweep, I have to go against it, and I jump somewhere here on the move. It goes against me maybe 2, 3, 4 points, and then it comes back. And so now then you are profit. But wait, we have maybe other ideas how to trade this one. I wanted just to say to see here whether this sweep is going to touch this one, but no, he cancelled everything. He was filled here. He was filled at 21. We can't say whether this was or this. Yes, this was intentional by him, maybe, but he wanted to trade. Let me see what was here on the 685. You see that? We have 700 on the 18. We have 770 or 17. We had 770 at 18. We have had 685, 700. At 21, yeah. I think it's okay to say this is one guy who wants to get filled here. And probably, you know what the beauty of this stuff is, when you have the time and you are not in the stress to managing your trade, then you can sit back and read the market. You see that there's one person, one institution who is chasing the price. I guarantee you this guy here was long. I don't know when he entered, but maybe he entered somewhere here. He was long, and he traded 700 contracts, roughly 700 contracts, and looked to be filled. You can see he stopped managing here. This, and lastly he he closed his trade here at 21, in the 21 area. What was it? 21 even. Impressive, isn't it? Good. We talked about this sweep, then let me show you another one. Let me show you another one. I have to find it first. Oh, yeah. By the way, with my method, or with adjusting or configuring your bookmap, like the way I have or I did is, you can click on with your right mouse button, window opens, click on the reset function here, and then you can select reset on double click. That means if you want to know really what is happening in this area, go back to the column you want to reset. This menu opens, then go to reset, click on reset, and check reset on double click. So you have a good control mechanism if you want to go deeper and understand what is really going on here, to start to make your studies. And you can double click and reset everything, and then you see exactly what was traded here in this area. Let me find the other one here. I'm not sure. Let me jump a little bit to save time. I think it was this one I wanted to show you. This is 1804. You can also jump in seconds and tenths of seconds if you place your cursor into this timestamp here over there, and then click gently on these arrows. So let's see what is happening here. Oh, just a moment here. Let me reset the numbers also here. Please mind the black area here. You see that? It left untraded areas between 20, let's say 20 and 19 here. It was a small one, but it was, first of all, remember, 90 degree, it is a 90-degree move. Every time it is 90 degree. Let's say 90 degree. We don't want to argue whether it's 85, 86 or whatever. It's 90 degree move. It's violent, you know. We talked yesterday that moves like that, this one here, needs time. So when you draw on line here, this move needed 15-20 minutes time to go up. And we have the bigger, the greater the angle here, the bigger the angle. That means this is a small one, maybe 45 degrees. When we have 90 degree angle here, when we're talking about it, this is a very, very fast move. That's the time factor. Don't underestimate time as a trading opportunity. Yes, the question is now what to do when this happens, or when that happens. What should I do? How to do that? Or what to trade? Jump on board? Maybe you got to fill here if you are short 1850, and I bet this is the worst idea you want you will have. We have a vacuum here. It's not closed yet. Closed, yes. It's not ready now yet. You see also the divergence here. We have huge volume. We have had huge volume. Please recall, please remember always that when we have huge volumes on the way up or down, then a lot of energy is lost. You can choose your own word for energy, or maybe you have a substitution for this expression. It doesn't matter what you use, but please mind that big volume areas are always subject to be subject for a correction. Big volumes area are subject for correction. See that? You don't need any whatever RSIs, CCIs, whatever indicator to spot this opportunities here. This was a wonderful example how to trade. We will come back, but I can't resist. Is that exhaustion 1725? You mean here?
It's a double bottom with a volume divergence.
Yes, it is. I can't resist to talk about now. Oh no, that's not so. But then we have the method not to trade this one because we don't know how fast what is traded and when it ends. But we get most of the time a second chance to trade it because we know that there are a lot of unfinished auctions here, or low volume nodes, or not traded areas here on the way down or on the way up, which are going to be closed most of the time. This is not a rule. This is not a 100% rule. But when we get a chance to be patient and to see this opportunity, then we seek an opportunity to go against the sweep. We are going against the sweep here. Against the sweep, guys. Not with a sweep, but against it. What I want to stress is that there's no volume because all energy was absorbed on this way down here. And this no volume means there's no one, there are no sellers anymore to push the price down. We will see another situation where the price retraces, but let me say roughly 50% of the move, and then the move continues further down. The other possibility we have, but What I wanted to say, because I don't want to, yes, because it's absolutely a picture book trade here. Let me see how this ended. Okay. You see, this move was good for few points. It's not that much what we expected, but anyway, doesn't matter. Every tick counts, every tick. Never trade in the direction of a sweep. Avoid the Pavlovian reflex. A sweep must be traded against its direction at the near end of the move. So you see that there are several examples, and let me talk about that again in the strategy section. I think the live example from yesterday's live example was impressive enough to understand what a sweep is and what happens in this during the sweep and how to trade it. Stop runs. Stop runs are part of the sweeps. You will now and then see stop runs, stop running. That happens when a lot of people are in the same selling or in the same direction, and suddenly out of nowhere, absolutely immediately, a sweep happens to the opposite side of the move. You will see that the stop runs are 1, 2, 3 points. Very fast. It's a sweep. It's sweep up or sweep down. It doesn't matter. And this triggers the stops. And a lot of people are immediately out of the market, and the stops are triggering, of course, the opposite side of the move. So stop runs are bottom or top formations that shoot beyond an absorption level to trigger stops in the immediate area of the absorption or breakout. Stop run triggers stops which are immediately executed at market. This triggers a fast counter movement which is intended. It's a slingshot move. Sweeps are the most causes for stop runs. We had yesterday one. I would like to show you this one. Let me find it first. I think it. Let me go back to 47. Before we are going through yesterday's recordings based on that what we have learned, I would like to show you how a stop run can look like or can be. At that moment here, either a lot of people jumped on this move down, or several are waiting and rejoined the move, or yes, rejoined or joined the move here in this area, 24, 23, and then this happens. It's not a big one, 22 to, what is this, 2 points, for example, 2 points. And this happens then. You see what the intention was, or what the intention is. If you are in the move, if you are in the trade, you are trailing your stop, maybe you're moving your stop down, then you will get hit by this single move, and then it acts like a slingshot. And leaves you, when you are stopped, when your stop was triggered, leaves you alone in the middle of nowhere because you have been right, everything was fine, and stop run happened, took you out of the market, triggered your stop, and then the move continues to go further down the direction you have planned, and so on. Also, let's have a little bit more inside look at this stop run. It's also 90, no, it's not exactly 90 move degree here, you see that, but it's very close to this 90 move, to the 90 degree move here. Absolutely very close. It doesn't matter whether it's 85 or 95, 94, 90, 85, 84 or whatever, 80 degree move. It is a fast move up, and this move tries to catch all the stops around here. We don't know for sure. I must say that we don't know for sure that this is really a stop run. But you will see this behavior very, very often in the traded, especially in the futures. Some of the people who knows how the market acts and what to do, knows exactly how to trigger you and to get you out of the market, and by that triggering you are forcing the move down here. It's not easy to spot, but the more you have in mind what we have learned this week, or what we are learning this week, the more you know the expressions of the market, the nouns and the verbs of the market, the better, the more conscious you will see and recall what the market is really doing and what is happening here. So sweeps are the most causes for stop runs, of course, as we have seen. It's like this one, you know. You see this is a liquidity area. It has been absorbed. Then they are going against you again. It goes your way, and you are sure that this market is going further down. So you place, maybe you get a fill at the second chance in the second leg here. You are short 28.10. And your stops maybe are 20.11 and 12, whatever. They're coming back with a sweep and then rushing down for 10 points without you. Yes, also this one could be classified as a stop run, but I don't want to put my hands on it because this is just overflow of this liquidity and absorption area. But it was absolutely impressive. It's the same one. You see that energy is lost on the way down. Look here at the volume. It's every time the same game. Once you see that, and once you when you are going to see that on your charts during the next days and weeks, you will have the right feeling and understanding what this is about. And mostly this is a so-called accumulation here. They are trying to buy at those levels here around and then bring the price further up. Okay, great. Now we have talked about liquidity, absorption, exhaustion, sweeping and stop runs. What we will do next are the confirmation indicators. That means these are the verbs of the market: order book imbalance, pulling and stacking, spoofing, channeling, book flipping, quote stuffing, icebergs or iceberging. I think the most of these verbs we have talked about. So that means we will go through them to complete this chapter, this topic about the active and passive indicators. Do you have some questions so far?
is there a, do you really know the difference between a sweep and a stop run until you confirm it with the indicators? Does it matter?
Not really, but not really, George, but it accomplishes the picture of trading indicators because the stop runs are happening now and then, and there is no explanation for this behavior. No, it's not so important like a sweep, but when you spot it, and the stop runs are only maybe 1, 2, maximum 3 points, maximum 2 points in average. Maybe you want to understand what is happening here, and when it happens at such areas here, like this one, you will categorize this move as a stop run. But really, yes, to answer your question, it doesn't matter. As long as you are on the right side on the market, as long as you are short and maybe your stop is over there here, 12, 2 or 3 points away, you're still in the game. It doesn't matter. But on the other side, what happens? Given that you see that this liquidity and absorption at 10 even here, and given that you know, okay, this is an area where I should sell, and given that you are not quite firm or you don't feel comfortable to take this trade here or the trade here, and suddenly you see a sweep up, and you remember that a sweep is a kind of capitulation, then you got an additional sign or additional indication that this area is for sure a sell area. This gives you the last confirmation that you are right. I mean, it can happen that sweeps are going 10 points through, then it happens, we have to accept it. There's no discussion about it. It happens, and if it goes against us, yes, it happens, and this is not a 100% proof system here. It's not. This is not a holy grail. But when you are in the trade and you see that, you can join the trade or sell here. You have the second chance. Look here, there's exhaustion to sell here again. But the third one was the best indication for a sell, because it was a sweep, only 1-2 points here, and then you can rejoin the sweep somewhere where you get a fill here. That's the point. So a sweep is only every time a sign of capitulation. Someone is, like in our example before, or yesterday's example before, someone is closing all his positions because he knows more. And by the way, so this was our sweep. And if we say a sweep is a kind of capitulation, then he emptied all his inventories. Look, I've mentioned it, I don't know when, maybe in the last seminar. You can also see when you go to the restrooms and you flush the toilet, that's the same behavior. So you flush the toilet, water runs out, and how it's saying, the bin, or where the water stays in, how do you say the bin is?
Septic tank.
Yeah, the tank is empty. The tank is empty. Thank you, George. The tank is empty and it must be refilled. So someone is flushing here his inventories, and he is empty at this moment.
That's a great analogy.
Yeah, you see that. So we don't know how big the tank is. Okay. Yes, good, great. You said tank, right, George?
Yes, that's correct.
Okay.
We call it a toilet bowl.
Toilet ball?
Yes.
Ball with two B-A-L-L?
No, B-O-W-L.
Ah, okay. Bowl, okay. Toilet bowl, thank you. I was looking for this expression, but yes, toilet bowl. Imagine this toilet bowl, so you flush it, the water runs out of the toilet bowl, and there's nothing more in. You see, there's nothing more what can happen. On the other side, this size, the length of the sweep between 20 and 25 depends on the size of the toilet bowl. It can be a small one, like this one, 20 to 18, 2 points. It can be a big one, between 20 and 25.
I noticed also in the opposite of the sweep, the liquidity comes out of the book also. I don't remember if I saw that with the stop runs, but both of these sweeps, that one up and the one down, you can see the liquidity comes out of the book from, for instance, the bids on the sweep up and the offers on the sweep down.
Very good.
Did that happen with the stop runs?
Right, an excellent idea. I have to put it on my... No, it doesn't. I think it was before here. When I go to the other examples, I don't have it, but there's a little bit liquidity here, so it's not so obvious as with normal sweeps. But it's a good point I have. So maybe we should consider that the liquidity characteristic of a stop run too. But as I said, and George mentioned it, I would like to say it's important to know, because such small sweeps can trigger stops, and stops are triggering the move. So keep in mind, but it's not, and therefore I'm maybe put it also in put it in brackets here. Good. Now confirmation indicators. We want to continue with the passive indicators. As said in my terminology, I said these are the nouns we are talking about, and now we are coming to the verbs, because they are absolutely important, because they're showing us that we are on the right side on the market. Order book imbalance. We have talked so much about it. It is mainly responsible for the answer, why does the price move? The order book imbalance, which is expressed by the numbers on the limit side here, on the ask limit side and the bid limit side. And you also can measure that in this order book imbalance measurement here. In the studies configuration, there is one point, order book imbalance. There you can adjust what you want to see here above in the order book imbalance indicator. It's like a gauge. There are imbalances on the bid side, there are imbalances on the ask side, and that's the measurement for those imbalances. You can set it in the studies configuration of bookmap by choosing order book imbalance. Then you can define the price levels up to your price levels. How much levels would you like to measure? 10, 20, or all available levels. You can even set a price percentage from best and bid ask. You can define that the lower half's life is weighted more than the upper half of the 10 of the levels you have defined here, and then you get a result here indicated in this indicator, in this gauge here in the book imbalance. It is really helpful sometimes. We should understand what it is, and order book imbalance is indicated by stacked or cancelled orders on the limit side. Indicates a change of expectation or mood of market participants. Why does the price drop? Because there is no bid, and that's the main reason why prices goes down or prices drops. When everyone is cancelling their orders on the bid side, the limit orders on the bid side is weaker. Remember the way of least resistance, for example, we talked yesterday. You see that also on the visualization part of the bookmap here, or of this of the presentation part of the bookmap here. There is no liquidity here. There is no liquidity there. Everything is trading or traded around here in this area. So this book is weaker on this side and on this side than here in between. High liquidity on limit offer means more resistance. Less liquidity on limit bid means less resistance. That means that is the reason why the prices are going down. And you can also then answer, why does the price move? Simply because there is an order book imbalance. And why does the price rise? Because there are sufficient buyers willing to lift the offer. High liquidity on limit bid means strong support. Lower liquidity on limit offer indicates low resistance. All these intentions are indicated by the order book imbalance. When we are talking about the order book imbalance, please keep in mind we are talking about the limit side, and the informed traders and institutions and the big guys who are playing the game every day, day in and day out, are using this mechanism of adding or stacking and cancelling orders all the time. They show us their hands, they show their intentions, what they are doing, what they want to do by different, by the liquidity they are providing on the limit side of the order book. You see that here in this scheme, in this example, we current price trading on best offer. That means here again 12 contracts, order book is balanced. That means we have 32, 24, 16 and 12 and also below 60, 80, 22 and 34. By that it is balanced because now have a look here. Let's find now, look, it's balanced now here. If you look, the green is 50% and let's say this red one, the ask side is also 50%. Let's see if we can find a strong imbalance somewhere. Sometimes you will find a large green bar going until the end of the of this indicator, and on the other side you will find a large red bar who is going through all these areas of this indicator. Let me find one. It's hard. But you see here, at that point again, the ask side is dominating. Minus 13%. That means the last 10 price levels here are higher than the last price levels here. Let me change this a little bit and try all available prices. What do we see then? It's a little bit more harder because it equalizes. The more price levels you have, then the book becomes balanced, more balanced, because they are counting every single level on the way up and on the way down, on the way up and on the way down here. It's much harder to see then. So now the bid side is leading a little bit. See that here? And then it changes. So I think it makes, at least for myself, to restrict the price levels up to 10 levels. And also you can give more priority to the last 5 levels here, so that maybe you get a little bit more indicative indicator than before. Let's find something really disturbing or high. You see how fast it changes, But anyway, I think you know what I mean here. So if we can't find an example very fast, it's okay. So current price trading on best bid. The book is balanced. Let's take the other one. Now sellers are come in, liquidity is consumed, and then what is happening, this is the intention of trade. That means, as discussed, they want to sell. The bid side is weaker than the sell side. Auction is skewed, seeks balance through price reevaluation. Liquidity pulls, spread widens as bid drops 2 ticks, for example. You see, it's quite obvious what we are talking about, because price is now looking for the way of the least resistance until they are supported by other buyers and say, okay, that's it, this is the area we want to buy, and they are putting liquidity again on bids, and then the game starts in the opposite direction. Spoofing is a part of book imbalance. We will come to that in a moment. Okay, book flipping. And we also talked about book flipping because it means that market makers are adding to bid offer to support one direction of the price. Mind changing gives mostly a reliable view of the price development. And let's go to the live example here, where we talked about around the sweep. Let me find this position here. It was, yes, it was that one here. This guy started here with 700 contracts at 12, 14, then 16. He trailed his stop, you see? He trailed his stop. Book flips. Book flips. He trailed his stop. He trailed his stop. He trailed his stop and got a fill here at 21. This is not possible again on this candle charts or whatever chart you are using. It doesn't matter. Simply, it doesn't matter. You can use what you want. I think I have a volume profile chart here. And it's not possible to see that in any case what is really happening here. It was yesterday. I think it was this move up here somewhere. The beauty of this of this view on the market, that you learn to read a market and that you learn to understand the market in real time. Book flipping. Market is going up and then supports come in. Market is going up, absorbed everything here, and the book supports the move up. Book supports the move up. Or move down here. Look here. They broke to this level of liquidity here. And then they are supporting the move at this price level here. Again, on the opposite direction, it is very obvious what is happening here. They were absorbed. Everything was out of the market here. But the traders are supporting the move down further and added to the order book here at 44 even. It doesn't matter. It doesn't matter if we are talking about 1 point, 2 points, 10 ticks, 20 ticks, 10 points, 20 points. It doesn't absolutely matter what's happening here. But when we see that, we should be very cautious with maybe longs, because as long as this liquidity sits here. So you see this one or this guy or this institution cancelled it again because they wanted to have lower prices for their own business. Pulling and stacking confirms observation, or it confirms that something great is happening, confirms also the direction. Bid and ask side are managed separately according to similar logic. Each side resets to 0 whenever the best price changes. The quotes delta displays cumulative size change of the price level since the last reset. It is a simple adding and subtracting mechanism because changing of volume happens fast. We are talking now, pulling and stacking, about these columns here. About these columns. We are talking, let me flip back here, about these columns here. When you're in trading and you have also the same mechanism, you see very, very well what is happening on this side here. It is a simple mechanism. It's absolutely nothing. This is no rocket science. It's simply crunching numbers. But because the refreshing part here is so fast, and here on the ask side is a bid side, it's not visible for us. I say not visible for us humans to see really what is happening here. So this is a helping mechanism here on the quotes delta to help us to see where the market tends to go, what the market is doing. You can see, for example, and you can see not, but now you can see a little bit better, that the market is trying to push the price down. You see how they are adding to offer side here. 498 traded now. And they're still pressing into the offer. Now the other side comes up. And it is not, I can't recommend to watch this all the time. I can't recommend that. Because when you are in a trade, then you want to manage your trade. You are looking for targets, you are looking for exits. You are trying to get maybe 5-10 points out of the trade if you are trading ES. So, but this is going at the edges of the trade, of the price levels, at the extremes of the price levels. It helps you to understand what is really going on there. Absolutely important. So let me show you an example. I will show you a second example then. It is a recording from last year. It doesn't matter. But please have a look just here in this column here. Quotes delta on the ask side and the offer side here. What is happening? The market went up and touched this area here and then creeped up to the next levels, 28.77 here. Okay? And everyone maybe is expecting that they are taking this one, 28.77, and going further up, going through this level of 28.77. Because, have a look here, the quotes delta is strong positive. We are talking about 275 at 76.5 here. And the offer side is weak. Look here. Then have a look what is going to happen here. You see that? There's a strong positive, and that's weak. That's not something we consider strong. Look here, we have 500 traded at the top of this price level. Gosh, we have 500 traded here at 76. This must go through, guys. This must go through. I guarantee you this is a long. Please put everything on green because it's going through this 77 level. 600. Something is happening here. Look here, there's a resistance. Strong positive, pressing up. Oops, resistance is coming up. Look here. 500 on the other side. 400. Refreshing here. They're trying 1,000 try to buy and lift the offer at 77 even. Look here, the resistance now grows on the offer side. $400, $300, $700 traded at 77 even. $1,700 traded at 77 even. Now, if you have alarm bells, so if you have in yourself and intuition an alarm bells, an alarm sitting, then now you as a skilled trader, based on the limit order book, on good data support and so on, here you should be alarmed. A red light should go on and bust all the time because something is happening here. And if someone is telling you, look here, they are trying to break this, they are going to break, this is a breakout trade, guys. This is a breakout trade. Go long. Look what happens here. 700. Look what happens here. They tried to lift up the price by selling 2,000 and more contracts into the offer, but the price didn't go up. That was my mistake here in the recordings. Needless to say, really needless to say that this price dropped down like a stone. I don't know what happened, how much, but anyway, it doesn't matter. It is so impressive. I would like to motivate you to stay with, to have this on your chart if you are trading high liquid instruments. Another example from last week, when you have the YouTube video, this is this one, and that's in classical because this is indicating, this is really indicating, and it says liquidity is there, and everyone who is looking at the liquidity, and therefore what I said about liquidity, it's important to know what liquidity is, but it doesn't answer the question, should I put my money on and expecting that this liquidity is supporting my idea and it is jumping to the next price levels? It doesn't answer the reliability of liquidity. Yes, it's there, but it is those guys who are playing with the liquidity. They are using liquidity to play with you, and you are the victim, not them. They are trying to lock you in here in this area, to lock you in, indicating, wow, we have a good floor. If you are a little bit trained on order book reading and order book trading, then you see that there is enough liquidity. How can the price then go back down? Maybe this one, this 90 level is far away, although in this case it's only 3 points. But look, listen to me, guy. Look, I want to buy here. I want to buy here. I want to buy here. And that's the trap. You can see the intentions of the market participants, of the market chasers, of the market uninformed traders, by looking at the order book first. In a high liquid market, of course, it's very, very hard to see that on CL or thinner markets. And you can see that on the quotes delta, whether they're pulling or stacking. So you see, okay, there's liquidity, but this is a huge trap, guys. This is only called distribution. They are selling everything to you. You are sitting there and thinking, oh, good. So I'm in. I'm expecting the next 10 points of this move. You see silently the liquidity is vanishing here. Very silently. And now you see the stacking on the offer side all the time. It's an impressive example, first of all, to learn how distribution works. Second, to learn what the lure is, to lock in people into certain trading areas. And you can only distinguish whether this is a trap or not when you read the limit order book here on this side. Yes, okay, coming back to quotes, delta pulling and stacking, bid and ask side are managed separately according to a similar logic. Each side resets to 0 whenever the best price changes. The quotes delta displays cumulative size change of the price level since the last reset. It is a simple adding and subtracting mechanism because changing of volume happens very, very fast. Spoofing or layering, we went through this again. Load the book in one direction and remove the orders before execution. Goal is to manipulate the price action, swelling the volume of the order book above and below the current price. Under the 2010 Dodd-Frank Act, spoofing is defined as the illegal practice of bidding or offering with intent to cancel before execution. You will see that nearly every day. Although it is illegal, it is not allowed, it happens. But when it happens, don't think about illegality or don't think it's not fair or whatever. It doesn't matter. It's not a question of to be fair or not to be fair. It's a question that it's a part of your trading mechanism, and because when you are short here, given you're sold a position here, then this guy is coming in and spoofing this the price down. They wanted to have a cheaper price to buy or to rebuy. Accept this spoofing or this trailings here as an additional indicator that shows you that the market is coming down, that you are right. If you are short here, it is an approval that you are right here. It is a part of trading, and you will spot that nearly every day. Spoofing can be as small as possible. You see that here in this picture. Or it can be a little bit larger than this one. This is, by the way, the similar behavior like that one we saw in here on yesterday's, based on yesterday's trading. It's this one, up, up, up until he gets hit. Accept this kind of indications as approval that you are right. If you are long, you get this. Other people, maybe people who are well funded, who has unlimited power of money, they prove that you are right when you are long here. Doesn't matter, we have liquidity in the way here. As long as he is not hit, everything is okay. Or plotted like a stair. You see, this is like a stair effect. These are stairs on the way up until they get the price where they wanted the price to be. Channeling is indeed really, really simple. Intend to keep the price within a price range in order to get filled on a certain price level. It's the same like, let me show you that here, when you are drawing rectangles. So I don't have a good example, but let's say this is channeling here. It's simple, a rectangle between high and low, and then they are pulling the liquidity at one side on the channel, and the price goes through. Channeling is the intent to keep the price within a price range in order to get filled on certain price levels. Goal is to manipulate the price within the price action within the range, and this is a disruptive practices which is prohibited. All orders must be entered for the purpose of executing bona fide transactions. Additionally, all non-actionable messages must be entered in good faith for legitimate purposes. Channeling like this one, you will see that the interesting point is the extremes of the channels here. The extremes at 77 and 78, for example, shows nearly the same amount of contracts sitting at those prices here. And even if you are looking for the large lot tracker in bookmap, you will see that also these large lot trackers, these small vertical lines, are there in the same position. Look here. This is the latest one. Yes. We have 800 and 700 here. It's nearly the same numbers. You know, you can trade also this channel or bracketing lines, because when you are coming from technical analysis, then you are told that these are really good opportunities. That means if the price approaches the bottom line, you are a buyer, and if price approaches the upper line here, then you are a seller. You can do this maybe 1, 2 times, 3 times, and then the fourth or fifth, the next trade is going against you because they are breaking out of this bracket. Quote stuffing, it's something I have not experienced. It's part of HFT trading, high frequency trading. Quote stuffing is the practice of quickly entering and then withdrawing large orders in an attempt to flood the market with quotes, causing competitors to lose time in processing them. That means you keep everyone busy because you have a certain intention to do something. High frequency trading in and of itself is not illegal. However, stuffing takes place when traders fraudulently use algorithmic trading tools that allow them to overwhelm markets by slowing down an exchange's resources with buy and sell orders in securities. You can call it an attack on the exchange. It's an attack of external traders, of high frequency traders on the exchange. Only market makers and other large players in the market are capable of executing these tactics, since they require a direct link to the securities exchange in order to be effective. It's really, really hard to spot. I had only one time in my career spotted this one here in the book. It was H9 contract. When you spot this, it's so obvious, you have to go against it, of course. So I said I have spotted it only one time, and I can't add any more to this behavior. When you see that, go against it, because this is a 100% trade. This is happened shortly after the session open. After the session start, you see that. Go against, because it's clear what they want to do, and then suddenly they cancelled everything here. You see that impressively in the book, what is happening here. Now, I would like to suggest I need your expertise on yesterday's market. Let me find the start, because you are no experts. We need some points more, but I think you can comment on this one very easily. We will start at yesterday's ES at 9:13 EST, that means New York time. So We will go in the preparation section about the preparation for the day. What happened, I started the recordings at 9 o'clock my time, the pre-session time. The market went up very strongly. It was a sweep. You see how it acted after it flushes the toilet bowl. Toilet bowl was empty. That was the outcome of it. And then the market is starting here. Okay, are you ready? The speed is twofold. Let me do it a little bit faster. It's 4 minutes before the open. This is the open. Someone flushed the toilet, or is still flushing. Liquidity acts as a liquidity acts as a magnet. So the price started, it drops heavily down to this area 23. First of all, if we repeat this game day in and day out and day in every day, we see that liquidity is an attractor for the price, because price needs fuel and liquidity is fuel for the price. Doesn't mean that this will hold and we can blindly take this as an bottom, that because the price is then going up to the next liquidity at 35. Yes.
It looks like there was absorption there, and then your play coming up to resistance as a book flip.
Yeah.
Possibly at 25.
Let's see.
But it wasn't fully absorbed.
No, not here. That was absorbed here. We talk about that a little bit later. But anyway, they are trying to protect this area 23 here. But you see also, let me do it a little bit slower. They are trying to push the price up, trying to press into the bids. But somehow, it was too fast. Somehow, let me go back a little bit. So, and just to show you what I mean with pulling and stacking. If you have a look at on this side, you see what is happening here. You can trace this one really where either you have working with jigsaw or other domes. It's not traceable with at least with our eyes. It's too fast, and sometimes, especially the open, it works better in the treasuries where you have 1,000, 3,000, 5,000 contracts on a price level. Then you can really follow the numbers. But now in fast markets, like we discussed yesterday, it's not possible. Let's do it a little bit faster. It's not what I wanted to show you, but the market is clearly down. So it's attracting again this 23 level. You see the pressure here on the offer side. Is this a good point to go long or to buy?
Possibly with the lower volume there, and they did press down and they couldn't get it to break through. But I see more liquidity coming in on the bottom levels, like 20 and then 19 and down at 17. So it would probably be a scalp versus unless you started seeing people coming in underneath.
Yeah. So it is at the moment it is really tempting to go long here at 23 because
I would agree, possibly, but just for a quick scalp.
yeah, of course, it's valid because we don't see a lot of resistance above 23 in this area. The resistance sits on 23, 22, 20 and 19.
How is that? I don't see a volume at the bottom of this chart. Okay.
Where what is the bottom of the chart? So it is, yes, it is of course tempting because you have two indications. We have a strong liquidity here and we have a positive number in the delta column. Let's further see what is going to happen. Strong numbers up, supporting the up move. By the way, if you experience enough and you got a fill here at 23.50, then you are in green here. By that means you are in profit. So so as far as I know myself, I wouldn't keep my position with 3 points stop. I would like to be very, very tight with my stop here. Maybe 22.50, something like that. Because everything can snap back extremely fast. So yes, it was because we have an indication, we have a good support here. We have a pressure up on the delta. Everything was working in our favor at that point here. And you see that we are in green. Everything is fine. And the next level, no, it's you to comment, excuse me. It's you to comment to me. Can you see what is happening on this side? At 23 and 3/4, 23.75. Can you please comment that one?
Absorbing the buyers.
Yes. Angelic, hope you see that too, and Tom also.
Yes.
It's interesting, they absorbed the buyers and the liquidity on the offers went down.
Yeah. Coming back, fighting this area again. You know, at that moment when we are entering, we have several good arguments for our trade. Good support. We have the pressure to the upside, and everything is absolutely nice, absolutely right, analyzed. That means we did it right. We got hopefully a fill somewhere here around 23.50 or 75, doesn't matter. And let me say, on other days everything is fine. We did everything in the right manner. Everything is great. And on some days it touches this level. It flows around this price area and then goes up and jumps up to the next level. 27 is advertising here, and let's see, maybe 35, 37. It goes straight ahead to 10 points up. Everything is fine, and that's what I'm saying. It's luck in trading, because we do everything right here, but the price does not prove us right, or the market doesn't prove that we are right. And by the way, we had, look here, the market is the market is undecided here. You see that by polling 23.50 and polling 24 even. You see that? Paul here, nobody wants to make business with me, and asking for 23.50. No one wants to trade with me. That means this is undecision. This is an undecided market for few seconds, very few minutes, because nothing is happening here. So who are we to force something? We have not enough power. I suppose we have not enough powers. That means maybe you have the power, but I don't have the power to move the market here up or down. So the market is undecided here. See that? There's no decision for the market, either to trade 24 even or to trade 23.50. Just to we are talking now because we have the time. It is an education session this week, and we are talking about it. So, but when you are in a trade and see, maybe you are long here because everything you did was absolutely right, and you see the prices coming back, and you see that one, this behavior here, then please notice that this market is not in, it's undecided. It's undecided. Simply, it's undecided. It's maybe it's also hesitant to do anything here. Something is maybe happening, or they're waiting for something, and now it comes to still need more power to eat all these bits here. And now the power is back. They are eating everything, and they are trying to resist here. You see that? The buyers try to keep this price. But I think I think there wasn't chance because it went down all the way. How do you call this one? This behavior here at 23.75. Let me go 1 second back.
They were coming down on the offers. They were pushing it down or spoofing.
Let me try to find the point. Now here, that's a good example. This is book flipping, guys. This is book flipping here. You see that at that point, 44 and 16 seconds, there's nothing on 23.5 here. And 1-2 seconds later, they are adding. You see that? At 23.75. We call it the book flipping because they are trying to put, you see how dark it becomes, or darker. They're trying to press the price down, to push the price to a certain level. Anyway, look at the offer side here. No, not now. It was before. This was this move here. This is out of nowhere. All the way the market is down. The market is down. The market is down. All the way the market is still down and it's going down. And suddenly, out of nowhere, a sweep happens. A sweep happens. I would like to consider, I would consider this one as a stop run. We have a little bit liquidity here at 23.75, but from my experience, maybe it's not valid for you, but let me say in my experience, this is a stop run. And if you see that and you are concentrating on the market in the first minutes when the market opens, you see that how should we treat sweeps, or how should we trade sweeps?
Against them.
Yes.
Yes.
Yes, against them. So if it happens, don't fall in love with a move here and think, yeah, okay, that's going further up. No, we have to go against them. Please keep in mind, we will discuss it a little, sometimes more here.
It's in my opinion, and I could be wrong, it's the weak shorts are getting taken out.
Yes.
From that indecision area at 23.75.
Absolutely. Yes, that's my thought too. So if you are maybe the first one, because we don't know what happens here today, yesterday, when we are long here, we have to be very concentrated on managing our trade here. I don't feel comfortable when this is going again against me. So even if it can happen if you are in and then go out, break even, for example, 1 or 2 ticks minus, if this is your style of trading, or if you think this is going further up and retesting this area. But if it hits the 3 or 4 ticks, you have to be out of them, of this trade. Doesn't matter. It happens. We can't prevent that it goes against us. This retesting that. But I'm very, very cautious with such moves. I would like to see that it goes 3 points up or 2 points up, then retracing, let me say 50%, and I'm still on my tight stop, maybe on break even, taking partials so that I'm not in jeopardy here, you know. So as you said, they are trying to stop out weak traders here. That's my impression too. There's no guarantee that this is right what we are talking about, about this explanation, but I think the same way. Yes.
Yeah, but this is also our first 15 minutes after the market opens, yes?
Yes. Let's do it a little bit faster. I would like to show you anything else what is really impressive. This all what we are talking about is theory. So let's take the time to go through the market behavior. The market is speaking to us all the time. But I wanted to show you something. Now the market is down, so you are not in the position because you are not sure what is going on, or you say to you, okay, the first 10-15 minutes I'm not trading. That's absolutely okay, because on some days they are trading only 2-3 points up and down until they are clearing their inventories and finding a direction. But what I wanted to point at, I don't know, we will see it in a moment, hopefully. I can't.
There's a serious book flip right there.
Yes, absolutely. Look here, 500 on 22. Now they wanted it higher.
Now they channeled.
But look what is happening here. I want to point you to this area again, because given we are not so brave that we are short from the beginning on, and there's also a valid argument to say, okay, stay out of the market for the first 15 minutes or 10 minutes. But let's wait the first 15 minutes what is happening in the market. And then we are looking to start, okay, the market is down. We will see in the correlation topic why this is a valid view on the market. And then we want to participate in the trade. You know, we see here stop run. We could join the market here, somewhere at 23 even or something like that. Or we missed that too because we haven't been concentrated enough to see that. And then we are looking for a second chance. Do you remember we talked about absorption and the pattern, the possible pattern? The market is going down, has a small retrace, or the market is steadily going down, find somewhere liquidity, then retracing back because some covered their shorts, and then continuing in the move down. No. Remember this foil and have a look at this area at 23. Again. Oh, that was too fast. That was simply too fast. I'm sorry for that. I missed that one. It is not the best example, but what I wanted to point at is when we... Let's go back here to 53. Oh no, excuse me, I'm completely wrong here. So that's the area I wanted to have. Excuse me. So let's go back again. Okay. This was the stop run here. You see how they are resisting that? This was an absorption. Here. This is the absorption. This is the huge traded volume at 2075. And let me show you that, what I mean. This is this one here. That one. And when that happened, it's not the big volume, but anyway, it is visually greater and bigger than all other dots on the chart. It's simply there. Something happened and they absorbed a good amount of volume here. 500, 600. And then suddenly the upper side, 22 and 23, is coming up. But it didn't give us a chance, or gave us a chance yesterday, to trade against this level. They flipped the book here. And why is this likely to happen? What is the intention of this book flipping?
Well, they've trapped some shorts down there.
Yeah, and they're showing the intention to support the up move. So it's the intention of these guys here to show. Look, they're adding 5. Maybe you see that here. Let me see whether I can zoom in better. Look here at 21.25 here. You see that 551 at 21.25, and it seems that this is in large order kept by maybe one institution or one good funded guy here. 21.25. You see that? Here's eager. I'm sure. It's only sometimes Australia. I'm sure here's eager to sell at a higher price or at a better price. Now this level is coming up, and in context of what we discussed yesterday, this absorption here, this exhaustion on that level means the price is maybe going towards this 23. Now we should be in the position to resell. That was the question. If we miss this move down here, where should we enter? We had 2 opportunities. I mean, this one was absolutely obvious and clear, this one, and the second should be around this area. But as said, we didn't get any chance to sell here 22.50. When you see then what is happening here. How do we call that here? What happened here?
They got their fills close, so they're done. They pulled.
No, I would like, yes, I wanted just to bring your attention that they have reached what they wanted because they wanted to press the price down, their muscles, and they cancelled everything. They cancelled everything. That means business is done here. They don't expect that this price is going back again toward this 23 level. It is done. I don't know because we don't know whether they wanted to this price level to sell again because it didn't get there. It didn't even touch this area, which should be this scenario for us. That means, yeah, did what they wanted. But when you see this one, when you see this pattern here in the liquidity, then you are sure that the business is done. They don't expect at this moment that the price is going back. There are other intentions. Maybe they want to have the price further down, but this was a good area to resell or to find a sell position here. So I would have waited until 22, 23 to get a short. It's a little bit annoying that they didn't touch this 22 area. So you have to rejoin the move. Absorption here. Small reaction on this absorbed level here. Small reaction. It is this one, this pattern. This could be also a stop run here. Hard to say. Let's do it a little bit faster. They are seeking liquidity here. I don't know, what was the low yesterday? It is really a rough day to trade, but as said, according our knowledge now, we have had a position here to enter 23 and we are still trading for 4 points. 4 points here, that's really, and it's a hard trade. This is really a hard, rough ride here. We are trading from 45, roughly 45 or 45 minutes around this area here. It's really hard to see what is developing. If we are short, then the best way is to have a clear direction, and we will see in the correlation section how you can determine the direction of a market, or at least in the preparation section, preparation topic. They're flipping again here, trying to bring the price down. But anyway, when you are short 22, 23, it's hard to resist because they are touching this 18 area. You are 4 or 5 points in profit, then they went against you again, then your profit gets smaller. Wow. Okay. Okay. That's the point where I want to discuss with you. It is really hard to find a good entry on the way down here. To be very open, it depends on your experience, what you know, how you prepare yourself for the trading day, and so on and so on. It's not easy. We had, maybe let's just say it, we had a long position here because everything pointed and everything was okay for a long position, but it doesn't work, or maybe it works only for a break even or for one tick. If you're lucky, that's absolutely okay, that happens. But then if you are not aware or you miss that, because, and that happens more than often when you are going for a coffee or you're going to restrooms or whatever, it happens in that specific moment that the market is doing something you are awaiting maybe 1 or 2 minutes before. So that's an unwritten rule of the markets, to do whatever they wanted to do or what you expect then when you're not around. That's absolutely normal. It's a little bit a joke, but anyway, it's my experience. So it's really hard to find an entry here. So you see the market's going down and up. We have a nice retracement area here. We had a nice retracement area. Even that didn't work. Even that didn't work yesterday. So, you know, we have been prepared to say, okay, this is the retracement area, this is my short area, 22, whatever, and my stop is 23, so I have maybe 1.5 point stop here. That's a reasonable trade, that's a good trade. Profit is maybe this area 17 here below. Didn't work, because we were waiting for this one. And rejoining, it's hard. Can work. Most of the time it goes against you for some a few points. That's the real trading situation. And then colleagues, this happened. First of all, what is this? What's that here?
Sweep.
Absolutely. Again, repeat myself, a sweep is a flush of toilet flush. The toilet bowl is empty. It must be refilled. And it indicates a kind of capitulation. It's capitulation. I don't know whether it stops here or wherever, I don't know, but anyway, it doesn't matter. This is a sweep. What should we do with sweeps? How do we trade sweeps?
We trade in the opposite direction.
Absolutely. Now let me draw a rectangle here around this area. I don't know how this works, but let's given we are absolutely skilled and educated and experienced traders. We did it really hard here to get into this move. Maybe we are in the move and we got 2 points of the move, then it goes against us. Maybe we are stopped out. It is annoying. It is demanding. Looking this for more than 1 hour, going sideways and going further down. It's really, this is one of the trading days where trading is not fun, for sure. But then suddenly we realize this one, the sweep. And given we are ready to go long here, let's see what happens. Just a moment. I think this window jumped down. I think it was here. I think my first rectangle was here. So our first trade wouldn't work here at this area. But then it can happen that you don't get a fill here and it works in you, and then it goes very fast against you. You will be stopped out here. But we have an energy loss on the way down. You see that here? The art is now to understand and to get an entry for a long entry, because we must go against this sweep. It sounds a little bit weird for you maybe, but you see that? This was the biggest one. And then the second one comes in. This is the second flush. Someone flushed the toilet bowl again. But the power of this flushing is going is less and less and less and less. So we are waiting until we get a reason to buy this area. It's really, I'm not sure whether I would how would I trade it, but it is for sure that this area here is a buying area. It's not the best example now. We had a sweep, it goes against us, and then it goes a second sweep and then a third sweep. That can happen, yes. But be sure that this area comes to an end. The question is then either 1 point below 15 or maybe 2 points below. This area happens, yes, 15 and 2 points below, they turned the market up.
But at the lowest point of this move,
yes,
looking at the very bottom, the volume, you really have a big divergence.
Yes, of course. There's a huge divergence. The question is now, we will discuss this one. The best one is they're coming back, retracing this area again, and you must be prepared that they are hitting 1 point or 1.5 point more, so they are going a little bit deeper or further of the bottom of the sweep. But look here at the volume. Look at the volume here, and then watch the volume coming down. This is the first flush, the second, and the third flush. When you see
like the third leg, and this is the end of it.
Yes.
With the very low volume at the bottom.
Yes, the question is now where to enter and what to do now. But the point is, we have to understand that these moves are the end of a swing. The best one is they are swinging back, retesting these 14 and 15 area, and then swings back. This was really a weird one, so I would have been stopped out possibly, and then I have to re-enter at a later point here. But anyway, that happens. We can't prevent that. But be aware that these sweeps are capitulation to the market. They're no more, and they're selling everything. They are canceling. They are closing their position, and they are turning back the price up to other levels. So if you miss the price, the way down, and it was demanding, then know that this area becomes an opportunity for us to buy or to go against the sweep. We have to go against the sweep. You see what is happening then when you go, maybe you get a wrong trade here, but when you reversed your trade here at 13, 14, anyway, you are good for 10 points. Then you can ride this sweep. But when this sweep happens, again, when this sweep happens, Close your position as soon as you can. Please keep in mind, given we are here and we see the sweep, the price is going further down, it swings a little bit lower, so between these are 3 points. Maybe you get stopped out, but you have never go with a sweep here and here. It can stop suddenly here and reverse. But when you are long and you got the luck that the price is going your direction, you're at 19, you have 5 points in plus, in profit, and then the market sweeps, or this happens. Close your position as soon as you can. Close your position as soon as you can. Don't hope that it can happen that they are coming lit back again and then flushing the sweep up again and going towards 28 and 30. It can happen. But I don't recommend to wait until it retraces against you, until it goes against this 18. And then what we have discussed is following. It was a fast forward replay here. But look at this guy here. I'm sure you will see that on your own when you are trading next week, or when you are observing the market next week and next weeks and month. Then you will see that this guy is supporting you in the way up. We have capitulation here. It's a little bit rough to get a nice and good entry here, of course. That's normal sometimes. But then you see these guys here coming up. So you are long, you wait patiently, you trail your stops, and this is coming up. And yes, you see that, you recognize it at the moment. Wait, we talked about there's someone who is supporting my idea. Then you know you're on the right side, and take his stops. You trail his stops here. And that's the beauty of the system, you know. You can use his stops here, or his levels, or these levels as your stops. Trail your stops to 17, trail your stops to 18, and then he closed this position, I think it was here, 21. That's the way we are trading that, and we don't need any artificial systems, we don't need any automatic systems or whatever. We don't anything in this on candle charts, because everything, even the live trailing stop, is shown on the chart here. And if you can look here, close your position at 21, 22. So given this is a losing trade here somewhere, because it shakes us through, and we are again, we must be stubborn. You know, we must resist to go with the sweep. It's hard. I know it's hard, but we must resist. We have to look for the opposite trade and see what is really happening. And given we are long here somewhere, then we are good for 4 or 5 points. That brings us in profit again. And when we see this, close your position market as soon as you can. So one strategy could be, we will talk about that, to wait for sweeps. Wait for sweeps. And this one, as we discussed earlier, this was a picture book, a picture book trade. That's what we want to see. Sweep. And a retest. Very clear entry here. Very absolute. Sorry?
I said look at the volume at the bottom. The second,
yes.
Second push.
Yes. Look here. That's a. We have several. We have 2 or 3 arguments. First of all, is the volume. We know what a sweep is, how it works. It's a flush of a toilet bowl. There's no water in the toilet bowl anymore. It must be refilled. It retests this area and accept a tolerance of 1.5 points. The second argument is the volume. All energy is taken out of the market. You see that here. Energy is known as volume. And look here below the divergence. Let's see what support from the book, supporting that without any mercy. They are supporting it. You see that. You see this short-term high liquidity. Short-term high liquidity here. You see that. How they are supporting the move. And in this moment, you know you are right. That's the beauty of the data visualization. Given you understand what is really happening here, of course.
Walter, I was thinking about, from a couple days ago, the long-term high liquidity and the short-term high liquidity. And it seems to me that the short-term high liquidity is a repellent and the long-term high liquidity is a magnet.
Yes, it is. If you define the short-term high liquidity as repellent, I would like to say it is supportive. So I mean, I know what you mean. It is supportive. The short-term high liquidity is supporting. You can also say it's repellent because the price bounces off this area here. I think you mean this.
I can understand it both ways for sure.
Sorry?
Yeah, I would agree that it's supportive. Yes, I would agree with that.
If you like to say repellent, that's okay, because the price comes to this short-term high liquidity and bounces off here, bounces off here. So it's like the south pole of a magnet, and this is the north pole, and they're bouncing off these poles, or it's repellent or it's supportive. Choose what you want. It's not important, just to know that this short-term liquidity is a push to the price to a certain high, long-term high liquidity level. That means we have one here, or was here sitting. We have definitely at 24 one long-term high liquidity sitting, 25 for example here. Yes, but it's the same. I know what you mean. If you want to describe it that way, absolutely. Now the profit was how many? 18, 20, 3 points here. we will see another example maybe tomorrow. Don't know what the market did today. What we learned from yesterday's market is when we are prepared right, we can re-offer or rebid. It depends on the direction of the market. In this case, I suggest if you know in the preparation what the market is likely to do, then to re-offer and to ride the move down. If you don't find an entry, if you really don't find an entry, and it's absolutely a little bit obscure, you don't know what the market is doing here, then wait for a sweep up as like a stop run here. This is the best one. Or you wait even for this sweep. And when we are lucky, then the sweep works right away, right ahead of the touchdown of the bottom, and it goes up. Sometimes it's a little bit more difficult to get in. But if you join this right, and you know that we have a huge volume here, if you rejoin this right here, this move here, then it's good for a few points. You know, and that's the next indication, this is the capitulation. You know that you have to you know that you have to exit the trade. You know that you have exit the trade if you're long. If you're not in the game, then you know you can rejoin, but it's really hard to get here in, and you have to exit here again. You can take this one and ride a move for two points again towards maybe, I don't know whether this VWAP is correct because this is only a recording here, for 2-3 points. So you have enough chances, you've got enough chances, or you will get enough chances to ride a move and to see all the fine stuff of the move, what is happening and where it is going to, where you have to exit. And if anyone to you in this trading circus, in this trading arena is telling you, we can't see the targets, we can't see where the price is going to, so be prepared to trade or whatever, it is simply not true. When you are skilled, when you know what to looking at, or where to looking at, then you will know also where to exit. I think the exits are more evident than the entries. The entries are sometimes really hard to get and to understand. I mean, hindsight, we need this method, this replays here to understand what the market is doing. But it's absolutely the best sign when this happens here. Because it's fast, 90 degrees, it's fast, it happens. So the question is, what do we do with the remaining time we are sitting in front of the screen and waiting for our entry? That's really hard to answer, and it depends really on you, and your character, your personality, what you trade, what market you trade, and how you want to trade. What I would like to do now is go through the order book visualization. We did it all the time. I would like to mention it and to finish the day with a quiz. We are now here in the left part of the syllabus here, bookmap organization and data. Order book visualization with bookmap. Why visualization? Advantages of limit order book visualization. Bookmap design and setup, bid ask, liquidity level, time slices, macro and micro view and settings. I think you agree with me that data visualization makes the trading or the analysis of incoming data, especially in trading, as well as in other sciences, for example, whether data analyzation, data visualization happens all over the world in the science and so on. But in trading, it's not so common. It is really uncommon. It comes more and more up. You will see software which is providing liquidity levels, for example, and so on. Footprint software is doing that nowadays also. But data visualization depends, as we will see, on data feeds and the quality of the data you are receiving, and only good data can be analyzed and can be presented to you. So you can make decisions, or we can only make good decisions based on the incoming data, on the quality of data, and that's absolutely important. It's absolutely, it's paramount. It's absolutely paramount that we have the best data and the best quality of data to understand what the market is doing. So the data visualization allows us to structure, evaluate, and better comprehend the meaning of display data, define terms for a common language, develop rules based on the defined language, and act accordingly across all platforms. So what we are talking here, I'm using the ES Mini, but you can use the same rules. You can make the variations of these rules up to your trading style as you want. But the language, what we have learned here, the nouns, liquidity, absorption, exhaustion, and the verbs like book flipping, spoofing, channeling, bracketing, and so on, this is common for every dual auction market. For every market on the earth you are trading, either in US, in Europe, in Asia, wherever you are trading, as long as you get the best data quality you can get. That means not only 5 price levels, not only 10 price levels, but any price levels who are indicated in the book, in the exchange. You can then the best understand and analyze, based on that what we have learned here, what the market is doing. When you are trading and not using Rhythmic or the X feed, we'll talk in the very briefly in the data feed section. If you are using CQG, for example, or if you are trading Eurex, then you got only 10 to 15 price levels of data, and these data are aggregated. That means you get only samples. You get not every single data out of the from the exchange, but they are sampled. It's absolutely enough, when we are talking about such charts. When we are talking about such charts, it's absolutely enough, You don't need to have high quality data to plot a candle, because a candle has only 4 states. That means open, close, high, low, or even range course, or whatever you are trading here, bars. It's absolutely sufficient to plot a candle with 4 states for one candle. But when we are looking, like we are looking into the depth of the market, when we are looking at the limit order book, in the depth of the market, and when you want to understand these sweeps, which are great trading opportunities, then we have changed our equipment and software equipment, of course, and also the data delivery equipment. So now, when we have everything in place, we can structure, evaluate, and better comprehend the meaning of display data. We can form a common language, like we did, or we are doing here this week. And now, when we here as a team understand this language, when we are discussing about liquidity, when we are discussing about absorption, exhaustion, and so on, then we can discuss on the same level. Like this short-term high liquidity can be repellent. Yes, of course. By that we mean that it acts like a support. The price bounce off this levels where this short-term high liquidity comes in, because it's support. But we are talking and understanding each other. We are not talking about, this is an I don't have it here. This is for a moving average, or this is an RSI, and this is a CCI, and now the price is bouncing or coming against the CCI level or RSI level or MACD level, whatever. And when you are talking with your colleagues who are trading and they are, for example, using MACD or they are using Ichimoku and whatever indicators, you will get at least several answers how to see and how to interpret, how to interpret these levels here. And that's the difficulty. You have 5 people in the room and everyone sees the MACD with his own eyes. But once you have a data visualization in front of you and you have the same language, then you can start talking about strategy and methods to organize this knowledge and to organize the data first and to organize the knowledge and then derive, for example, strategies out of it. But it means we saw that everything is relative. Visualization is relative to the selected time frame. Small dot, small volume, large dot, large volume. Liquidity levels are relative. Relative to the zoom level, time level, and so on. That means we have a historical part here on the on bookmap. This is the historical part. We have the traded data here. You can also trade off bookmap directly into TradeStation, into Ninja Trader, for example, into Interactive Brokers or whatever. You can trade directly from the chart through your broker, from bookmap through your broker. And you have also the opportunity to define a depth of market and DOM here. You have also time and sales, for example. You can add time and sales to your chart here. You have an indication panel here, or indicator panel. You can write your own indicator based on Java, through which are interacting through the bookmap's APIs. And so it is organized. We will talk about cloud data, or we talked a little bit about cloud nodes, so soon cloud nodes. You can include it or automate that, but we have this historical data, traded data, and the depth of market here. This is the organization. Sorry. In this manner, this is organized this manner that we have the historical part, the actually traded parts here between those lines, and the price here. We have the price, we have the depth of market, we have also indicators here sitting below which we can use, sharp delta, cumulative delta, and others. So, and everything is relative. So that is it seems that there's a long-term high liquidity here at 21, but when we zoom out, it disappears suddenly. That is also valid with the dots. What I'm using here is, just to show you volume dots, I'm using volume delta dots. You can also use total volume, then you see the split between buys and sells on the volume, in the volumes here. I'm using volume delta, which is a little bit more comfortable for myself. So I'm using also 3D bubbles instead of 2D normal bubbles, because I think it's, at least for myself, a little bit more beautiful. Everything is relative, meaning of dots and volume, and that's what when we are talking about sweeping, I find this very nice cartoon on the net. It's an old one, but it's true. So and anyone starts, I've got a stock here that could really excel, sell, sell, and then the panic comes in. And that's what we can explain with these movements here. It's not exactly the same, but when you look, do I have? But when you look at the yes, when you look at the yes, you see that and you compare. Let me show you again. You can compare this behavior. Oh, come on. You can compare this up move. You see how fast it goes up. Absolutely scary, because we need a good or decent retracement pullback here. Then you can compare it to this behavior here. Sell, sell, sell. Then everything is in panic. Everyone wants to buy. Everyone wants to buy. Everyone wants to buy. Then the market goes back, back, back. Then sell, 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 sell. This is madness. I can't take anymore. Goodbye. Goodbye. Bye. 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 And it goes. Excuse me. This is this one here. Bye. 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 And the panic started again. And then the wheel turns again. The wheel turns again. So it's going down. It's going up, and so on. Never trade with but against big volume. Avoid the Pavlovian reflex trap. Most traders are trapped at highs and lows. That's what we learned in the sweeps. But when you are an investor who are not day trading, if you are a long-term investor, for example in shares, then you have also to obey the same principles like we learned for the day trading in ES. It's always the same mechanism. When we have pullbacks, then it's more likely that it's going up, 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 up. You should have a look at different markets to see whether they are exaggerated at the moment or this specific moment, and so on. All these mechanics apply to every market. Now we are concentrating on day trading. And by day trading, I mean for myself, day trading is not to scalp, not to go for one tick, but to get maybe 2, 3, 4, 5 and more points out of the market with 1 or 2 trades. That's my goal. I don't want to make the broker rich. I want to make myself, yes, comfortable, rich. I don't know, but to make myself rich. That's my goal. So when you see big bubble, please keep in mind, don't go with the big volume. Stay aside. See this volume maybe as absorption on any way. If you want to split the dot, you can split the dot in, and you can get the information out how much was traded, at what time was it traded, and you can read out what is really happening at the lowest. Let me show you that. When we zoom in, at the lowest possible level. The lowest possible level. That's absolutely fine, guys, when we are discussing, and sitting together, have a glass beer or wine, and discussing the behavior of the market, and why is this red and why is this green, and so on and so on. What happened here? That's absolutely okay. But in trading, we have only 2 questions to answer: when to trade and where to trade. Please keep in mind that you can change, but maybe you know that you can play with the display here above and with the size of the dots. You can use a gray, black, black-white chart. You can use a blue-yellow chart, and also you can use a blue-red chart here, background. And it depends on your, that's on what you want. Yes, it depends on you, what you like, what colors you like. It's not so much to select, but if you want to play around, you can do that. Also you see, also when you when you go with your cursor here, You see also the volumes displayed in the time, stamp and volume and what happened. So you don't need to have the data tooltip on. You can also, if you are interested in this bubble here and this dot here, you can point at it and you see the information here in the information center. My trading advice to finish this chapter is following. Use higher time frames and don't lose yourself in micro view. You want maximum profit with just a few trades. I know colleagues who are doing 400, 300, 400 trades a month. And they are in profit, they are still profitable. That's absolutely okay. It's not my goal. I would like to do 4, 5, 6 trades a day and end up with 5 to 10 points a day. Sometimes it works fabulous and great. Sometimes it's a little bit harder, like yesterday, for example. I'm sure it would be yesterday. I recommend to use higher time frames and don't lose yourself in micro view because you want maximum profit with just few trades. That means you can trade this way and take every possible information out of the market. Or you can also trade this way to see really what happened the last hour, what happened the last 1.5 hours here. You see the sweep here, you see the sweep here. What is happening? We will talk about VWAP. And then you will maybe try to find an entry and to go for several points. Hopefully, when the market proves you right and you have luck on this day, this trade can or could go from 18 to 25, for example, to this liquidity level. So it depends on when you are in, then you are trying to find a target or two targets, several targets on the way up or way down, depends on where you are. Then you have to manage your position. Don't give anything away. If it goes against you, close your trade immediately. And then use the dome as a guide for you. When you see something unusual in dome, for example, at this distribution area, like shown in YouTube, close your trade, enjoy your day. You did a great job following this seminar up to here. Thank you. To relax, I have prepared a short quiz about market mechanics. You will find the link to the quiz in your confirmation email you got when you purchased this online seminar. If not, please send an email to education@ddwtrader.com. Tomorrow we are going to start with the part 6 strategies, and we are going to the correlation part, which is absolutely important. Then we are flipping to or going to daily trade preparations, and after the preparation section we are summarize all the strategy, and I have put some strategies for you together based on that what we have learned. We will have hopefully enough time for exercises tomorrow, but it is absolutely important that we are going to the strategies and correlation section. Correlation is so important. You will see why, and you will see how to utilize it for yourself, or utilize yourself, or using for yourself in your daily preparation, because it allows you to say or predict, I would like to say predict, what the day is offering you in your instrument, what is likely to happen in your instrument when you look left and on the right side. That's absolutely imperative to know and to go through that. And on Friday we will do other nice stuff around bookmap and the additional indicators in bookmap, and doing also exercises. So have fun, enjoy your life, and we meet tomorrow. Bye bye.